Hi, I'm Vanessa from Premier Tax Solutions, and this video is about how to read accounts, and it's another one in our Accounting Basics series. So you've paid all this money to an accountant because you don't know what you're doing financially speaking. The taxman scares you and they've said that you've got to provide them with information. You might also have to please Companies House and the whole thing just makes you want to throw up. Then somebody like me comes along with a pile of papers, presents them to you and says, we need to have a conversation and I need you to sign them and say that you agree to what's been put in there, and inside you're thinking, OMG. Don't worry, we know that you didn't go into business because you're great with accounts and finance, well most of you anyway. That's why we're here. The way that your accounts will look will depend on how you're trading, the size of your business and the accountants that you use. The two bits that are most important that apply to all businesses are a profit and loss account, sometimes known as an income and expenditure account, and then the balance sheet. The P&L shows a summary of transactions for a period of time, usually 12 months, and a comparative period, which is also usually 12 months. This will show the sales for the period and the expenses that relate to those sales. So it might be you've got an electricity bill that was paid 2 months after the year end, but the actual period it relates to was within those accounts. That electricity bill will be brought into the account because it relates to costs of the products that you sold during the period. In the same way that something that you sold at the beginning of the year might have had its raw materials bought in the previous year. The cost is shown in this year as that is when the sale took place, not last year when you bought it. These adjustments due to timing set on the balance sheet so that they don't get lost or forgotten about. The balance sheet shows a snapshot of the business at the end of one particular day, which is known as the end of your accounting period. This will also show a comparison of the previous period's figures. These timing adjustments are things that probably sound foreign to you, so debtors and creditors, accruals and prepayments. There's also possibly depreciation, amortisation and deferred tax that might pop up too. These are accounting transactions, not actual monies that you have in the business or that you owe out. I know, it's confusing. We don't just make stuff up though. Depreciation represents the fall in value of the capital assets in your business. Amortisation represents the fall in value of any intangible asset such as goodwill. And deferred tax is the amount of tax that you'd have to pay if you shut the business and then sold all the assets. Looking at the P&L, turnover is your sales, direct costs are those costs that are directly attributable to the goods that you're making, so things such as raw materials. If you deduct the direct costs from your sales, you get your gross profit. Overheads, administrative costs or indirect costs are those costs that are not directly attributable for the product that you're making, so for example the rent on the building or the telephone expenses. If you take your gross profit figure and deduct the overheads, then that gives you your net profit figure. This is also known as profit before tax. All these figures feed into your balance sheet. On the balance sheet you always start with fixed assets at the top. These are assets that the business own and are likely to be in the business for more than 1 year, such as a car or a piece of plant and machinery. Then you have current assets, which is the amount of money that you have in the business. So this can be made up of money in the bank, cash and money that is owed to you. Below this are your business liabilities, so this is any money that the business owes out. This is split between monies that are owed in the next 12 months and monies that are owed out in over 12 months. Those amounts due more than 12 months from now would typically be something like a loan or finance on an asset. The total of all these assets less the liabilities gives you a figure. This figure should match the other total on the balance sheet. This shows you that the accounts balance and that all transactions have been accounted for in the double entry system of accounting. The other total on the balance sheet is a share capital if it's a limited company, plus the total aggregated profits or losses of the business, up to that particular date, less any dividends that have been declared. This is the total of the money that's still in the business. We hope that we've shed some light on a difficult topic for you, and get in touch if you've got any questions. Remember, no question is a silly question. Thanks for watching.